David Nicholas joins me this morning. David, Amazon reports after the bell. Are you expecting a blowout report?
I hope so, Stuart. Our clients own the stock. I personally own the stock. This really comes down to Amazon Web Services. Yeah. So I want to see what are the results around it, what is the commentary around it. Overall, I like the stock. Just what we're seeing last week, we saw with Google, what we saw with Microsoft. AI cloud was huge for them. This bodes well for Amazon, and Amazon cloud revenues are $90 billion. Ads are the next thing I'm following, Stuart. $46 billion in revenue just from advertising. So I think those two segments, if we see some growth there, it could be a blowout day for the stock, Stuart.
All right. Apple reports Thursday afternoon. Under what circumstances would you buy Apple currently priced at $173?
Here's where I would buy it. It's a hold for me right now. They've struggled with China. This communist growth story that we thought was going to happen, it's been disappointing. We haven't seen it. So Apple's having to shift. Here's where I would buy it. If I see a pullback of 8 to 10%, I am diving right in with it. If we don't see it and the stock pops, I think it's because they're further along with AI than the market thinks. I just think we're not going to see that. So I'm saying hold, wait for a pullback, and then buy this stock left and right if we get a nice little 8 to 10% pullback, Stuart.
I've been looking at the earnings reports that we've seen so far in this quarter. What strikes me is that profit margins appear to be going up, expanding. I would have thought that was pretty good news for the market.
Stuart, that's a great nuanced point to bring up, because one of the fears was going into this earnings season, we see inflation not going down, we see inflation going up. How are corporations going to stomach this continued high increase in wages, high increase in costs? Well, guess what? Corporations have figured out a way to get through earnings and also do it while increasing profit margins. That point is key, Stuart. It's why I think we see this market holding on. I think we still have some legs going forward.
So, okay, legs going forward. So we're not looking at some serious decline. And we're not looking at a major breakout either. It's steady as she goes and slightly higher. Is that it?
Stuart, a lot of people miss this, but you just brought up about profit margins. This comes down to either companies are profitable or they're not. We're seeing companies produce profits. That's what the market wants to see. So until we see that declining, Stuart, at least in the short term, inflation for corporations hasn't hit it as much as I think we thought it would. Why? Corporations are raising prices on products. They're raising prices on services. The consumer bears the burden for that. But right now, the consumer is willing to pay. Why? Because employment is stable. If we see the employment situation, Stuart, change, that's when I'll start to get concerned.
Do you guys pay much attention to the Fed these days? We always say you can't fight the Fed. You've got to study them hard. The progressive interest rates is all important. Well, is it now?
It's still important. It still matters for the market. But you know what? This is an environment that we're in that's in a higher rate environment. But I think the market needs to be prepared, not for rate cuts. We could see rate hikes. I know this is not what the market wants to see, but that changes the game. We're preparing ourselves that we could see a rate hike because the Fed has done the opposite of what it's telegraphed. The Fed has done the opposite of what the markets believe. So that's what I think you need to be prepared for, Stuart.
So how do you prepare for it? Real fast. You've got 10 seconds. How do you prepare for that?
Own short-term bonds, don't go out long on the curve, and own quality balance sheet companies like Amazon, Microsoft, Google, the big names with a lot of cash, Stuart.